Well, it's time now for our Muni Moment segment where we focus on the top stories in the municipal bond market. Joining us is Taylor Riggs.
Hey, Vonnie, yes, and joining me is James Iselin. He is the head of municipal fixed income over at Neuberger Berman. Jamie, as you know, the big question is that Supreme Court yesterday, they heard arguments about whether to let states start collecting sales taxes from internet retailers that don't currently charge a tax on their customers. My big question is, how badly do these states need that revenue?
They need it badly, Taylor. You're talking about significant amounts of revenues, by some estimates, billions of dollars. And if you think back since the financial crisis, states and local governments have been raising revenues in the traditional ways: personal income taxes, corporate taxes, sales taxes. It's very hard to raise those taxes much higher because the rates are so high to begin with. And in a post-SALT world, there's just much less flexibility to do that. So we think you're going to see this as something that could be very important for municipal issuers.
Yeah, you know, another important thing for municipal issuers, of course, is budget season. We're in the middle of that. Last year was a nightmare, one could say, especially when it comes to Illinois and some of the other states. How are we expecting budget season this year to go?
I think it's going to be another tough season. You're right. Last year was a total nightmare. You had New Jersey, Pennsylvania, Illinois, Connecticut, all with late budgets. That was very unnerving to the muni market. I think the place to look at this year, again, is the state of Illinois. They passed a bad budget last year. They had to use an override of Governor Rauner's veto to pass the budget. And the politics there are just as toxic as they've ever been. So I think that's one to look at. I don't like Illinois GOs further out on the yield curve. I think you should wait for a better entry point as the budgetary process plays out. But there is an interesting trade on the short end. Right now, you can buy a 2-year Illinois GO at a yield of around 3.25%. That's almost double the yield that you would get on a AAA-rated bond with the same maturity. Basically, you're getting 2 bonds for the price of 1. We think that's a really good deal if you can tolerate a little bit of headline risk.
Okay, staying on the short end of that curve. I like that. You know, and another key theme has been the relative outperformance of high yield versus investment grade. But you're arguing that you would sort of come up in credit quality now to have some more liquidity. Why? What's the argument there?
Spreads are incredibly tight. So much money has come into the market from central bank liquidity. They're pulling back right now, and when you look in the last year, the spread on the high yield index has come in by over 100 basis points.
Okay.
I think now is the time. You want to be up in quality, you want to be liquid, you want to be nimble so that when volatility picks up, you have things in your portfolio that you can sell to take advantage of hopefully bonds at a much better price down the road.
Okay, so a little up in quality and a little shorter in on the yield curve.
Exactly.
Wonderful. And Vonnie, that was James Iselin. He's head of the municipal fixed income over at Neuberger Berman.